Good morning and welcome to this webcast with Magle Chemoswed in relation to the company's report for the full year of 2021. The company is today represented by CEO Justin Pearce and CFO Petra Jönsson, Sjölin. My name is Alf Riple. I work at Västra Hamnen Corporate Finance and I will be your moderator today. We will start with a short presentation by the company, and after that we will have a Q&A session. You can ask your questions by writing them. There's a field on the right side of the screen or the bottom of the screen, depending on your unit. You can expand that and write your question. It's called questions. You write your questions there, I will read them out and the company will answer. All that remains for me to say is that this session is being recorded and that the recording can later be found on Västra Hamnen Corporate Finance channel on YouTube and of course on Magle Chemoswed's homepage. So with that, I give the word to you, Justin and Petra.
Super, thanks Alf, and thanks very much for hosting us again. It's great to have you guys support us this way. 2021, Petra, if you could. Full year statement for 2021 was a year that was in equal measure exciting and challenging for obvious reasons with COVID and the various market restructurings that have been going on. But I really do feel that over the last year we built a really strong momentum, especially through the two last quarters of the year, and we've generated an outcome that is in support of our strategy. We followed our strategic principles very well in building long-term value both for shareholders and into the company. We increased our investments quite significantly into research and development, as well as in initiating our value creation 2024 programs, which are part of our strategic alliance to increase our margins, secure our revenues, heighten our returns, and also allow for more liquidity into our investments in our DSM products. So overall, the team did a truly fantastic job, and I think 2021 was a year that we are significantly proud of, given the circumstances around the year. This is no short part down to the long work that has been done in diversifying our revenue model, making sure that the company is insulated from various shocks in different segments. So out of the 5 segments, we've certainly played more investment into the development and sale of the new DSM products with the acquisition of Pharmacept. We've continued our existing relationship with the royalty agreement, and as you'll note in the royalties received for 2021, we had a significant decline in those royalties, based primarily around the COVID situation and some slowdown in manufacturing at one of the manufacturing sites. Otherwise, the diversification of the revenues across the generic active pharmaceuticals that we have to the more traditional CDMO contract manufacturing and contract development services allowed us to insulate the business quite well from the various setbacks that last year had and COVID brought with it. So overall, I think de-risking the business and having a good diverse spread on the revenue model has primarily assisted the business in continuing good performances in 21. We managed to stay in line with our growth strategy, first and foremost establishing direct sales for our DSM products. The Pharmacept organization was brought in June, and of course we've increased the numbers there quite significantly, so we've almost doubled the size of the company over the last 6 months in bringing in new direct sales reps and new people to work with the products on the medical affairs side as well. Focused a lot on the increased profitability of the CDMO projects that we're having, and I think we can see that reflected in the figures, that giving us a good bottom line, a good margin in relation to the CDMO activities that we've done. As I've already alluded to, we've accelerated our pipeline, we've increased our development work. That also means we've increased our investment into that area. So we really do see that the tie-in between the accelerated pipeline, new DSM products being pushed through the establishing of the direct sales organization in Pharmacept is something that we see great value for the future, both in growth and stability for the company. We've also focused a lot on operation efficiency. We've been very active and very proactive in our negotiations with suppliers, with customers, with passing on various cost increases as we've seen, around the raw material side, especially on the CDMO and the manufacturing side. And a lot of our operation efficiency programs have started to pay dividends to us as we see a stronger bottom line performance year on year between 2020 and 2021. The financial summary for the year, net sales essentially are almost identical to 2020. We had a slight change in the way we recognize some of the build-through costs related to the CDMO projects. But in essence, we're quite satisfied where the sales came in, where the sales revenues came in, also taking into account the severe reduction in royalties year on year, being almost 14 million on top of that. EBITDA and operating profit certainly in line with our expectation and forecast. We had to bring in a lot more manufacturing, and we brought in some more CDMO projects in order to allow us to substitute for the decline in the royalty revenues over the year. So the business, and again going back to the revenue model and the risk approach that we have here, allowed us to move some things around and reallocate resources to make sure that we could protect the top line. And then our efficiency programs in relation to profit after tax really started to generate good returns for us on that. So on the whole, both in the last quarter of 2021 and the full year for 2021, we're quite proud of what the company has done in terms of performance, both in terms of revenue. We're also very proud of the fact that our networked model is really starting to pay dividends to us and allowing us to allocate costs around the business and to pick up revenues in different segments of the operations. When it comes to the DSM products, of course, we are driving these, as I said, since the acquisition of Pharmacept. We significantly increased the numbers of people into the organization, but we've also been driving registrations into Latin America for Envacept S. So we see this as one of the larger untapped markets for us, where we have a lot of interest in the product, and those are in advanced stages now in terms of registration. The SmartPAN study is still on track for 22 as we expected it. We will start that study in Q2. We have the ethical approval from the hospitals, and now it's just a matter of the first launch of manufacturing of the SmartPAN product in order to support that study. So that's ongoing. We've also received the first commercial order of the AXA wound gel. So this is underway. We currently have it in manufacturing, and we intend to be able to supply that towards the end of Q1, beginning of Q2. And I can say that all of our medical devices that are approved and CE marked for sale in and around Europe and for mutual recognition around the mutual recognition countries in the world have been re-audited in early January and finalized in February. And we have passed through both the ISO and the CE marking audit on all of those products. So we're good to go, as the saying goes. In respect of the DSM pipeline, this continues at pace now. We certainly allocated a lot more resource to three of the projects out of the pipeline have been brought forward. The prostatic artery embolization product, Envacept M, this is now really moving forward. We're in late discussions now to do some very quick observational clinical studies to support that while the file is being prepared for registration with the regulatory authorities. And the uterine fibroid embolization product now is pretty much at the same status level as the Envacept M. The wound care product that we have, this would be the next product to come out under Smart Gel and the AXA wound gel. This is now through the final preclinical testing. So the results there are very positive for us, and now we will look to move that project on into the upscale and validation stages before looking to make a regulatory filing probably late this year or early next year. So on the whole, the company has managed to perform fairly well for us. Certainly our initiatives and our strategy are starting to pay dividends to us. And this year we will focus primarily on the DSM pipeline, establishing the higher numbers in our direct sales force to push the products, and try and supplement that with additional territorial registrations of the products. So with that being said, the financial performance of the company for 2021, I will pass over to Petra to make the presentation on.
Thank you, Justin. So looking at the financial performance, as Justin has been through as well, looking at the net sales for the period and also for the full year, we have for the same period in Q4 for 2020, we have a similar revenue on the total net sales, despite the different changes throughout the year. But looking at the full year, we have a slight difference, and this is also due to some royalties are missing, which is 14.3 million. And also we have some revenue recognition changes that we have done, as Justin mentioned before, about the bill-throughs. And looking at and summarizing that all together, if we would have received the royalties as expected, we would have overshooted 150 million this year. But this is not the fact, but just giving you the information about the changes and what we have done to try to recover for that loss. Looking at the bill-through cost, which is the other revenue streams that we get through, and these are primarily bill-throughs that we have recognized as other revenue throughout the years for agreements that we have made with customers and for other purposes that we have seen to move forward. For looking at OPEX in terms of what we have in terms of raw materials, as you can see, we are a slightly bit higher on the raw material side from the different quarters, but not much in terms of that. Looking at the full year, we are way below, almost 10 million below. And these are, as Justin said before, negotiations with suppliers, but also cost controls that we have put in and some stress tests that we have, making sure that we are valuing on inventory on the correct value. Looking at the raw material, in spite of that, we also have production going on for the fourth quarter, looking at it in terms of shipment going out from our warehouses, and also a slowdown in late December because of holiday season. For the other operating expenditures, we can see that we have a bit higher cost throughout the period. This is primarily due and linked to our change in the sales mix, which I will go into later on. But due to the fact that we have not as much royalty was as expected, we have to fill that gap with DSM products, but also with our CDMO services and business. Therefore, there is a higher demand on our consumables, but also on our external analysis, which are supporting the services that we're providing to our customers. In general, otherwise, we are in line with our expectations, and we have looked at it in terms of the bottom line. We are above our expectations, and the full year outcome of this, we have been able to be still profitable and have a good margin on that part. So a profit before taxes at 5.6 is a good outcome with these controls of the cost of going out, but also making sure that we are covering the net sales decline that we have seen for the royalties. So looking at the sales mix. So our focus during 2021 was to decentralize the revenue mix and also making sure that we are decentralized or decreasing the risk of it at all. So looking at the generic manufacturing, you can see that this has decreased from 39% of the total sales mix down to 27, which is one change due to the fact that we have seen a slowdown in demand, but also slowdown due to COVID during 2021. And this has been that we are to start increasing the services that we are providing to our customers as a contract development and manufacturing services. So as you can see, they have increased by 26%. In total, it's actually 29% growth from previous year. What we can also see that the license and the revenue, which is the yellow part here, has declined from 17% in 2020 to 12% in 2021. and this is actually a decrease of 14 million SEK. And as we can see, for during the acquisition of Pharmacept and starting to roll out our own sales team in Pharmacept, we can see the increase of direct sales in the market with 11 million Swedish krona. So you can see the blue part, which is the DSM sales. So this is good, and this is what we are looking forward to increasing. Looking at the cash and liquidity that we have performed during the year, we can see that the cash from operation has been positive throughout the year and is in line with our expectations. For the overdraft, we can see a more stable and consistency compared to previous year in terms of having usage of the overdraft. And then looking at the liquidity is, of course, as you can see in Q1 and Q2 are following our acquisition of Pharmacept and the first installment payment for that. So this is how it looks like currently. To make a summary of the year and summary of the financial year is that, as Justin said before, despite the low revenue from the licenses, we have been able to successfully transfer the revenue to our DSM technology, but also to our CDMO businesses. And we're able then to compensate the loss for that. We have made cost savings on our raw materials in terms of cost control, but also agreements with our suppliers, and successfully changed our gross profit. Should not be 87%, it should be 83%. Sorry for that. And the other operating costs we have, of course, due to the change of revenue stream, has increased because the royalty income or revenue has no cost in general. But of course, the CDMO businesses and the DSM is gaining more cost on us on looking at that. Also, what we do see is, as everyone know about, is the electricity that has increased throughout the year in terms of cost and availability. We do see a high maintenance on our facility and machinery to be able to increase the external services and the demand that we have. So this is also a factor of the increased operating cost. We are really proud of the performance that we have made and that the teams of us have achieved throughout the year, and be able to reach the pre-tax profit of 5.6 compared to previous years is a great success. That is all from me, so thank you. Justin, do you want to add anything?
No, thanks, Petra. I think it's a strong performance for us for the year, and we're all set and ready to run into this year, and hopefully the year will settle a little bit more than we've seen over the past couple of years in relation to the COVID impact and the other geopolitical events going on. Alf, it's all yours.
Well, thanks very much, Petra and Justin, for that presentation. It's time for Q&A, and I would remind everybody in the audience that you have the option to ask your questions by writing them. There's a little field called questions either on the right side of the screen or the bottom of the screen. If you expand that, you can write your questions there. I will read them out and the company will answer. But just to kick it off, I want to go over once again what you mentioned there, Petra, about the cost of goods in the quarter. So the reason why you have a slightly lower gross margin this quarter than in the previous few quarters is partly to do with royalties being a smaller part of the total, right? So a smaller base of revenues brings up the costs in relation to revenues, but it also to do with the costs themselves. I thought you said so. You mentioned electricity.
Yes.
And
so,
what
so
other?
looking at so looking at the Q4, if you compare it to previous year, it's actually at the same level in terms of the raw material and consumables. So looking at it in terms of what we are manufacturing compared to what we are actually shipping out throughout the period, we have a lot of customers asking for the material before Christmas, and this is what we're trying to make sure that they have it in time before Christmas as well. We have a downtime for the production. We are shutting just a few days before Christmas, and then we allow people actually to go on holiday. So therefore, we have a downtime on that, and that also shows that we have a similar outcome as previous year in the same quarter. But as you mentioned, we do have an increase of the OPEX in general for other external costs in terms of electricity and also the maintenance that we're doing on our facilities to make sure that our instrument and machineries are up to date to fit our customers' need of the services that we are providing for them.
Okay, and you know, a lot of companies are reporting now during the last few months with trouble in the supply chain, cost increases, and also trouble to get the raw material that they need. Have you also noticed that in your supply chain?
Yes, we have, and looking at it in terms of it's more of a fact that we have a high demand on for ethanol, for instance, which is across the world. It's a big aspects of it. It's looking at, and we are trying to negotiate with different suppliers to make sure that we have it and we can get it on time to not stall our production sites.
Okay. And also one of the notable aspects of this quarter is that you have quite a bit lower royalty payments than, at least compared to our estimates. In many of the previous years, you have averaged about 30 million Swedish in royalty payments from Becton Dickinson for the full year, which would average out to about 7.5 million Swedish per quarter. And this quarter, I believe you had about 2.5 million. And it was roughly the same in the last quarter. How do you look upon the path going forward from here? What do you think you will eventually go back to the 30 million per year, or is it even a backlog that could give you a period of higher royalty payments, or do you expect it to be around this level?
Alf, I don't expect there to be a backlog coming in to give us a short-term boost. I think this was I know this was a direct relationship between the COVID slowdown in terms of number of surgeries performed, especially in the predominant market in the US, and this was just a pure supply and demand game. So less surgeries require less product requires less manufacturing, and yeah. As we start to move now into 2022, at least the word on the street from them is that they expect to start to return to pre-COVID norms and levels in terms of quantities and material. So whether we return there fully in 2022 or whether it runs forward into the first quarter of 2023 will depend largely how quickly especially the US healthcare system can get back up on its feet and get these surgeries back in and going. But we certainly see a more stable forecast, at least looking forward over the next couple of quarters. So I would expect it to come back to the pre-COVID levels. Whether that happens in 2 or 3 quarters or 4 quarters, I think is something we still need to navigate.
Okay, and maybe you could remind us again, how far into the future does this license agreement stretch?
So it ends the end of 2030.
Okay, so still a good few years left in it.
Yeah.
Also, I mean, you managed to incorporate the PharmaCept into your business. Do you see this process as complete now, and is it fully staffed for the sales efforts that you are planning?
Yeah, I mean, of course, integration, especially culturally, always takes a little bit of time. So we've certainly integrated the main aspects of it. I'd say the finance and the financial reporting is about 90% integrated now. In terms of the management into the management groups, this is ongoing and work that we're doing. In terms of strategy, yeah, we're integrated. We all know where we're going. In terms of staffing, no, we still have some staffing investment that we would like to make this year. We're certainly looking at increasing our sales footprint in Europe. So we'd like to extend out of Germany, where we've been solidifying over the last 6 months with new people. So the main recruitment up until now has been to capture fully the German market. And then the two markets that are primarily of concern for us are France. France, we currently are undergoing a reimbursement evaluation by the French authorities that we hope to close by the middle of Q2. And if we can close that successfully, we will employ new people to take care of the sales in France directly. And then we're also evaluating the incorporation of a direct sales force into the Nordics now as well for those products.
Okay.
So there are our expansion plans for recruitment on the sales front for 2022.
Okay. Is it possible to quantify the headcount that you're looking for?
Probably another 6 to 8 people.
Okay, great. You also mentioned that you are shifting the portfolio mix in the DSM portfolio to more higher return products. Is this something that you expect would show up in your margins going forward? And is there any particular product that you would give higher or lower priority in order to drive this?
The products where we have really high margins, Embecept Air, Smart Pan, etc. We see those products as being, very high market potential with very low costs associated with them, with good returns. The Smart Gel is one that's slightly more challenging. The wound care market is, of course, more competitive when it comes to price, is more regulated, especially in Europe, by the governments and the healthcare systems in relation to that. So yes, that product probably needs a little bit more work, but we would certainly push the registrations and push the existing products that we have around the Embecept family out. And we also see in the prostatic cancer, prostatic embolization, the Embecept M that is coming to the closing stages of development now and into registration. Here is a product that also has a very niched high return market entrance for us. So in terms of priority, I think it would be Embecept, Smart Pan, embolization for the prostatic, and then a little bit further down the list in terms of sales to return would be Smart Gel and Axowind Gel.
Okay. Since you bring up Smart Gel, I was going to ask, you mentioned before that one of your intended markets for Smart Gel was the Russian market, and of course with the tragic events unfolding, I guess that is not a priority at present. How are you addressing that situation, or adapting to it rather?
Yeah, I mean, the political situation aside, the Russian market, of course, is a difficulty for us at the moment. In order to mitigate that, we're currently looking at removing some of our launch plans away from the Russian market, concentrating a little bit more onto the Mexico's and the Canadian markets. So we will probably shift focus to both or one of those markets.
Okay. Does it mean anything in terms of timetable for launching a product?
Yeah, of course. It probably has an effect of I would say 6 to 9 months for us to ready up to that. There's a lot of document translations. There's a lot of IFU work that needs to be done. And of course, there are different regulatory landscapes in those two markets in comparison to the Russian market. So yes, there is some catch-up work for us to do in order for us to be able to pivot that product from the Russian market into one of the other markets that we've identified. Okay.
Different question. If we turn to your future plans in terms of investing, you have said in a report that you're going to have that the DSM market role is going to be capital intensive in 2022. What kind of investments are we talking about? Is it purely marketing or development, or is it? Are you also thinking in terms of M&A? Any such thoughts, and if so, in what direction will that be?
We of course, we're always interested. The company has grown both organically and inorganically, so we're not scared of an acquisition. There are some potential candidates that we can see would make interesting acquisition targets for us to really expand our line, both on the development side, certainly in the preclinical workup of the products to have that joined on. We can see a good cost synergy saving in relation to that, and we can also see an acceleration of development by having control of our own preclinical work. So that's one aspect that we're looking at strategically. The other side is also looking within Europe to grow, let's call it inorganically, through strategic acquisition on the sales and marketing side. So we have an organic plan, which is recruitment, and we're certainly doing that, and we're driving that with Pharmacept. But if we were to find an interesting candidate within Europe that could really add to and support and help us accelerate growth on the sales and marketing side, then of course that would be very interesting to us as well. Okay. So yes, we're constantly looking for acquisition. The company is built on strategic acquisition in any event. In relation to coming back to the other part of your question, where would we see the sort of capital intensive part of this? We have three. One is on the regulatory side. So we would really invest quite heavily to accelerate regulatory filings, both in Europe and outside of Europe, into the territories that we see as potential high returns for us. So that would be one investment point. The other investment point would be growing the sales force. So that would be pure human capital. And then the third, of course, would be bringing products forward out of our pipeline. So we would expect to increase our R&D expenditure on the DSM products quite significantly. I think currently we would probably look at increasing between 30 and 40% year on year in terms of our revenue expenditures, our R&D investments.
All right. And at the same time, I couldn't help notice that you have less than 4 million Swedish in cash on your balance sheet at the end, close of the year. It doesn't look too precarious since you had the same balance a quarter earlier, and you can operate on very little cash, it seems. What is your liquidity reserve? You mentioned the overdraft facility, Petra. Is that your main reserve, or are you planning on maybe establishing some more permanent financing? Is it possible, for instance, to raise long-term loans to give you a little bit more of a buffer?
Sorry, I had to unmute. So looking at it, we have overdraft of 20 million. So this is current state of what we are using. And as I said, also, we have not seen that big of a use of that during the year. As you can see, we have quite a stable overdraft need looking at it at the moment. So there is other options that we can take up on if we need to. Looking at the other peers in the market, they have a quite more overdraft than us, and I think talking to the banks, there will not be an issue to extend our overdraft if so needed.
Okay, so I take it you're happy with the financing situation at present. Well, I don't have any more questions, and I haven't received any more from the listeners. So I think I'm happy for now. Is there anything you would like to say in closing, Justin or Petra?
No, just thank you for making available and for most of the questions. And yeah, no, I have nothing else to add.
Lovely. Well, thanks very much, Justin. Thank you, Petra, and thank you to those of you who have been listening. And we hope to meet again here after your next quarterly report. Thank you very much, everybody.
Bye.
Thank you.